In exactly 48 hours, the most important date in the silver market this year arrives, February 27th, the COMEX March First Notice Day. And if you own silver, or you're thinking about it, what happens on that day could change everything. Here's what most people don't understand. COMEX is not a market, it's a promise machine. Every single silver futures contract is a promise to deliver 5,000 ounces of physical silver. And for decades, that system worked because almost nobody actually asked for the silver. Traders would buy the contract, ride the price, and roll it forward into the next month. The silver never moved. The vaults stayed full. Everyone was happy. But something broke. Starting in late 2025, people stopped rolling. They started demanding delivery, real physical silver. And the numbers that are showing up right now are unlike anything we've seen in the history of this exchange. Let me walk you through what's happening. March is not a regular month. It's a major delivery month, the single most active silver futures contract of the entire year. This is when the big players show up: hedge funds, banks, industrial users. In this March, the open interest, meaning the total outstanding contracts, represents approximately 429 million ounces of silver. Let me put that number in perspective. The total registered silver sitting in COMEX vaults right now, somewhere between 85 and 103 million ounces, and it's dropping every single day. 429 million ounces of demand, less than 100 million ounces of supply. Now, in a normal year, this wouldn't matter. Because in a normal year, maybe 5 or 10% of those contracts actually stand for delivery. The rest roll forward. But 2026 is not a normal year. In February, which is a minor delivery month, the delivery rate hit 98%. Let me say that again. 98% of open contracts demanded physical silver. In a minor month, that's not a futures market anymore. That's an allocation mechanism. People are not trading silver, they are taking silver. And now we're 48 hours from the major month, the biggest delivery month of the year, with the highest open interest and the lowest inventory in years. This is the setup. And in this video, I'm going to break down exactly what's happening, who's behind it, what the historical parallels tell us, and what I think comes next. Stay with me. Let's go through the data, because when you see these numbers side by side, you'll understand why this matters. Number 1, delivery acceleration. In 2024, total COMEX silver deliveries for the entire year were 203 million ounces. In 2025, that number more than doubled to 474 million ounces. Every single month in 2025 saw higher deliveries than the same month in 2024. This is not noise. This is a structural shift. Then January 2026 happened. In a single month, a historically minor delivery month, 49.4 million ounces were delivered. That's 4 times January 2025, and more than 7 times January 2024. People are front-running March. They're grabbing silver now before the big month arrives. Number 2, the inventory collapse. In October 2025, COMEX registered silver stood at 167.7 million ounces. By February 2026, it had fallen to roughly 103 million ounces. That's a 38% decline in just over 3 months. But here's the critical detail. The drainage rate has been accelerating. We're losing approximately 785,000 ounces per day from the vaults, per day. If that rate continues through February 27th, which is the first notice day, the available registered silver could be down to 85 million ounces or even less. Number 3, the delivery math. If March sees even 25% of contracts standing for delivery, which would be historically normal for a major month, COMEX would need 107 million ounces. That's potentially more than what will be available. But what if the delivery rate looks anything like February's 98%? Then we're talking about demands of 200 to 300 million ounces against 85 million available. Now, I need to be clear about something. A COMEX delivery doesn't necessarily mean silver physically moves. It's a transfer of a warehouse receipt, a warrant of ownership. The silver can stay in the vault while the warrant changes hands. So the system has mechanisms to handle stress without physically running out. But here's what those mechanisms can't handle. When warrant holders start demanding withdrawal, when they want the actual metal out of the vault. And that is exactly what's been accelerating. Number 4, the price signal. Silver is trading at approximately $87.87 per ounce as of yesterday. It was $80.46 just 5 days ago on February 20th. Gold is at $5,192, near all-time highs. The gold to silver ratio has been compressing, which historically signals that silver is catching up. But here's what the mainstream is missing. Silver surged 24% from its recent bottom after the historic late January liquidation. That sell-off, which briefly erased nearly 50% of silver's value, was driven by speculative activity, particularly from Chinese traders, according to U.S. Treasury Secretary Scott Bessent. The market is telling us that despite massive paper manipulation, physical demand is overwhelming supply. The Shanghai Futures Exchange silver contract is trading at premiums of $3 to $5 per ounce above COMEX. That premium means physical silver in Asia is more valuable than paper silver in New York. When the price of real metal diverges from the price of paper promises, the paper system is under stress. So who is actually draining the COMEX? This isn't random. There are three major forces at work. Force number one, China. China has been systematically reducing silver exports. This is not speculation, it's documented policy. China controls a massive share of global silver refining. When they restrict exports, the rest of the world, especially Western exchanges like COMEX, feels the squeeze immediately. And there's a strategic dimension here. China is the world's largest consumer of silver for industrial purposes. Solar panels, electronics, electric vehicles, they need silver. And they've decided they'd rather keep it than sell it to the West at prices they consider artificially suppressed. The Shanghai premium I mentioned, $3 to $5 above COMEX, is the market's way of telling you that China is willing to pay more for silver than New York is offering. That's a gravitational pull that's slowly but surely draining Western vaults. Force number two, industrial giants. This is a story most people have missed. Samsung, yes, the Samsung, through its subsidiary Samsung C&T, finalized a mining prepayment deal with a Canadian company called Silver Storm Mining. The deal gives Samsung exclusive rights to 100% of the mine silver concentrate output for 2 years. Read that again. Samsung didn't go to COMEX. They didn't buy futures. They went directly to the source and locked up physical supply before it ever reached the market. This is what happens when major corporations lose faith in the exchange system. They bypass it entirely. Tesla and other tech companies are reportedly making similar moves. When the biggest companies in the world are securing physical silver through direct deals rather than exchanges, that tells you everything about where the smart money thinks this is going. Force number three, retail and institutional stackers. The silver squeeze movement that started in 2021 never died. It evolved. Physical silver demand from individual investors has been running at record levels. PSLV, the Sprott Physical Silver Trust, has been adding metal consistently. Mining companies are reporting that buyers are increasingly demanding physical delivery rather than paper settlement. And here's the feedback loop that makes this dangerous for the short side. As inventory drops, it creates urgency. As urgency rises, more people demand delivery. As more people demand delivery, inventory drops faster. This is a self-reinforcing cycle. The COMEX has tools to fight this. They've hiked margins multiple times. They can invoke Silver Rule 7, the emergency rule from the 1980s that literally banned buying and only allowed selling. They won't let the exchange formally default. But here's what they can't prevent: the repricing of silver to a level that reflects actual physical scarcity rather than paper abundance. And that repricing may be starting right now. Let's talk history, because this has happened before, and every single time the result was the same. 1980, the Hunt brothers. Nelson and William Herbert Hunt accumulated roughly 150 million ounces of silver, about a third of the world's supply at the time. Silver went from $6 to $50 per ounce in months. The exchanges responded by invoking emergency rules, changing position limits, banning new long positions, and only allowing liquidation orders. Silver crashed from $50 to $10. But here's what most people miss about that story. The Hunt brothers were two people. What's happening now is millions of buyers across dozens of countries. You can change the rules on two brothers. You can't change the rules on a global movement. 2011. Silver's run to $49. Again driven by a combination of monetary policy fears and physical demand. Again stopped by margin hikes. CME raised margins 5 times in 8 trading days. Silver dropped from 49 to 33. 2021. The Wall Street bets silver squeeze. SLV saw massive inflows. Physical dealers sold out. Premiums over spot hit 30 to 50%. But the paper market held barely. Silver touched $30 but couldn't break through. Each time the establishment won, but each time the margin of victory got smaller. And each time physical demand was higher than the time before. Now it's 2026. Silver already broke $100 in late January before the forced liquidation. The late January sell-off, where silver lost nearly 50%, looked like victory for the shorts. But within weeks, silver recovered most of those losses and is pushing toward $90 again. The pattern is clear. Paper manipulation can suppress the price temporarily, but each suppression creates more physical demand because stackers see low prices as buying opportunities, and each recovery happens faster and goes higher than the last one. What's different this time? The inventory. In 1980, COMEX vaults were full. In 2011, they had hundreds of millions of ounces. In 2021, they had over 300 million. Now, under 100 million and dropping every day. The playbook is the same, but the ammunition to execute it is running out. You can't deliver what you don't have, no matter how many rules you change. So what happens after February 27th? I see three scenarios. Scenario 1, the controlled repricing. Silver moves to the $100 to $120 range. COMEX manages the delivery process by using existing warrant transfers, convincing some long holders to accept cash settlement at premium prices, and hiking margins aggressively. This is the most likely outcome in the short term. The system bends, but doesn't break. Scenario 2, the squeeze acceleration. If March delivery rates approach anything close to February's 98%, we're in uncharted territory. COMEX would need to source metal from LBMA vaults in London, which creates logistical delays and exposes the global nature of the shortage. Silver could push to $120 to $150. At this level, we'd see mining companies fast-tracking production, recycling increasing significantly, and industrial users scrambling for substitutes where possible. Scenario 3, the systemic event. This is the tail risk. If enough warrant holders demand physical withdrawal simultaneously, not just warrant transfer, but actual metal out of the vault, the entire price discovery mechanism breaks down. COMEX could invoke emergency measures, potentially including force majeure clauses. Silver could spike above $150 before the system catches up. This is unlikely, but no longer impossible, given the inventory trajectory. Now, what about gold? Gold is at $5,192 today. Central banks have been buying aggressively. China's PBOC extended gold purchases for 15 consecutive months. Goldman Sachs has a $5,400 target. The structural case for gold is completely separate from silver. It's driven by de-dollarization, debt concerns with U.S. national debt above $36 trillion, and the 15% tariffs that just went live this week. But here's the connection. If silver's COMEX delivery crisis creates a loss of confidence in paper precious metals markets, gold benefits enormously. Because if paper silver isn't worth the contract it's printed on, investors will ask the same question about paper gold. Here's what I want you to take away from this video. February 27th is not the end. It's the beginning. The March delivery cycle will unfold over weeks, not days. The data will come in gradually, and whatever happens, it will set the tone for May, July, and the rest of 2026. What I'm watching? COMEX daily delivery reports starting February 28th, registered inventory levels, the Shanghai premium, and whether any major exchange invokes emergency rule changes. If you found this valuable, hit subscribe and turn on notifications. I'll be posting updates as the March delivery data comes in. Check the description for timestamps and links to my previous COMEX analysis. This is Money and Empires. The countdown is on.